Hello, I'm Tony Kay. I'm the editor of Eureka Report. Welcome to Q&A, Advisor Q&A. I'm joined today by our financial advisors, Bruce Brammall and Max Newnham. Welcome, gentlemen. Thanks for coming in again.
Thanks, Tony.
Now, today we've got a really interesting topic in light of circumstances, and that's understanding the new pension rules. We've got lots of people tuned in for this one. There's a lot of confusion out there in terms of what the new rules mean when they come into effect, what some of the recent changes mean for them as well. So I thought we'd start off today just by going through what the changes are. Just before we get to that, I should say that today's session is general advice. We can't provide you with specific superannuation advice or pensions advice, but we certainly want to get to your questions and answer them as closely as we can. For more detailed support, we'd certainly recommend that you speak to your financial advisor or an SMSF specialist. So we'll move on straight away. Max, I'm just wondering if you wouldn't mind running through what the actual changes are that are coming into effect.
Yeah, Bruce and I were saying these are some of the biggest changes we've had in 10 years, and there's some of the biggest adverse changes to the taxation of super in 30. But basically you can narrow them down, and it's not all bad news. The biggest piece of the bad news is the $1.6 million pension transfer balance cap. Now, that just basically means people from 1 July 2017 won't be able to have more than 1.6 million in a pension account or transfer it into it. The situation is any excess has to go out of it, but that's one of the big ones. There's the reduction in the concessional contribution caps from 35 to 25. There is also the reduction in the amount that people can put in as non-concessional contributions, and they've kept part of the old system relating to there is a limit that can be contributed after 1 July, which is 100,000, and you can bring forward up to 2 years. So it's going to be $300,000 under the new system, but they've brought in a second threshold that once a person's superannuation balance exceeds the pension transfer balance cap, you can't make any more concessional contributions. So once someone gets to 1.6 million, they can't make any further concessional contributions.
No, non-concessional contributions.
No, sorry, non-concessional contributions. The other good thing is with concessional contributions, they've taken with one hand and given with the other, because people will be able to carry forward any under contribution to the limit for 5 years. That happens, the first year it happens is 2019-20, I think.
Not next financial year, which is 17-18, yeah. So yeah, 18-19.
Yeah, yeah. And that basically means if over a 5-year period, someone has contributed $10,000 over those 5 years each, in the fifth year, they actually can be contributing about $100,000 as a concessional contribution. So they're probably, is there anything else?
Look, they're the main ones that people have been, that will affect readers, to a large degree.
Yeah, and then on top of all of that, we've, from the start of this year, we've had that change with the pension assets test as well.
Yeah, that was the bit of a double whammy where we went from the 1.2 or 1.123 as a maximum assets you could have to get the age pension, to where it's dropped down to about the 816 mark.
So that's caused a lot of angst for people.
A lot of people who were getting a part pension have been cut off, basically, and won't get the age pension going forward.
The only piece of bright news out of that was anyone that did lose their pension at that date do get to effectively keep their healthcare card for life, because it's now a healthcare card with no income tests or things like that on it. So that is a benefit, that anyone that lost the pension, they get to keep the healthcare card and their income can go to whatever level they want. I mean, which is interesting in this situation. If someone chose to transfer money out of super into their personal hands, and they're therefore earning more income in their personal hands, that would have meant that they would have had more than the 86,000 as a couple or whatever it is, where the healthcare card is available, they won't be affected.
And just one more thing, I don't think you mentioned it just then, Max, but the transition to retirement pension, there's been impending changes around that as well.
Yeah, of course. Well, look, so one of the big changes we haven't mentioned to date is that TTR pensions, TRIS, whatever you want to call them, will start to be, the pension funds themselves will start to be taxed from July 1, 2017. So I have written a column recently in regards to that. If you have the opportunity to shift your pension from a TTR pension to an account-based pension, an ABP, then you should take it. So that can be things like changing jobs after age 60, retiring after age 60, and making sure that your super fund, if it's not a self-managed super fund, if it's a retail or industry fund, making sure that they're aware that you have met a condition of release, changing jobs after age 60, so that it does change from a TTR to an AVP, because that'll stop the fund itself being taxed. It doesn't change whether it's a TTR or AVP. The pension that you receive is still going to be tax-free if you're over 60, but it's about making sure the fund itself isn't taxed, which TTRs will be.
Now, today's session is all about the new pension rules, so we'll keep to that, and all of your questions seem to be around the pension changes. If you are confused about what's going on, you're certainly not alone. So stay tuned in and we'll get to your questions as we go along. The first question is really just around the $1.6 million transfer cap. How does that work? That's a question from Mark.
Well, basically, there's going to be two triggers, and the triggers are anyone that's got an account-based pension now and has it in existence at the 30th of June, they automatically will have a transfer balance cap of 1.6 applied to what their superannuation pension balance is, and if they're going to be in excess of the 1.6 million, they have to get it back into accumulation. There are some major benefits by doing that before or on the 30th of June, but then, so that's how it works for people who are existing pension holders up to the 30th of June. From the 1st of July, the pension transfer balance cap works on the basis that you cannot transfer from an accumulation account into a pension account more than 1.6 million. And that's pretty much in the nutshell what it's all about.
Yeah, so there's a couple of questions around this issue, Tony. Let's say somebody has $2 million in their existing pension account. 1.6 million of it will be able to stay in pension. The other $400,000 will need to be transferred back to accumulation. Certainly, one of the questions was asking, well, do we need a second, a bank account and a separate, tools to hold the assets? The answer is no. It becomes an accounting audit, actually a question as to what's in and what's out. But in that example there, $400,000 needs to come back to accumulation, and the 1.6 million needs will be able to stay in pension, tax-free pension.
Okay. Now we've got a question from Jerry. He wants to know about segregation of assets and resetting of cost bases. There's been discussion around that. It's highly confusing and very technical. So I'm just wondering if we can respond to that in a simple way.
I'll have a go at first, Max, I guess. If you're essentially, we've been writing about this and talking about it. The whole industry been talking about what we were going to do from the May budget last year until later on in the year, and a lot of the strategies that were being talked about were sell some assets in pension phase to get a new cost base, or liquidate while it's still in pension phase. Other ones were, well, we decide which assets we want to keep in pension, effectively segregation. We want these high growth or high income, whatever strategy worked best for you, in the pension fund, and we'll leave that. So those assets will be in there and these assets will be in here. The government came out later in the year and said, no, we're not going to allow you to do that. Essentially, we're going to make it a proportionate method. So just for easy numbers' sake, let's say you have $3.2 million in a pension now, and half of that, $1.6 million, is going to have to go back to accumulation. Then there's some cost-based resetting, which I'll talk about in a second, but essentially half of the assets in your super fund will be taxable at super rates, and half will be tax-free in pension. Now, coming back to the resetting of the cost base, which you need to make an election prior to the putting in your 2017 tax return for your self-managed super fund, as to whether or not you want to reset the cost base to the value of the assets on July 1. What that means is that you might have bought an asset for $5 5 years ago. That asset has risen in value to $10. So on the 1st of July next year, you take the option to reset the cost base at that time, when a portion of it has to be transferred back to your super fund. So if it comes back at $10, if you subsequently sell it, let's say 3 years later for $15, then you're able to ignore the $5 gain, the original $5 gain that was made essentially while it was in pension, going from $5 to $10, and you'll have to pay tax on the gain from July 1 till the time you sold it, which was from $10 to $15. So in a nutshell, that's what they're talking about here with the proportionate method. There are a few other rules around it, as in the asset needs to be sold within 10 years.
There is this situation, though, from a point of view of the way the concessions will work differently depending on whether a fund is regarded as segregated or unsegregated and proportionate.
Correct.
And interesting, if you have a fund where all of the members are in pension phase, that will be regarded as a segregated fund because everything is in pension phase. And if a fund is a segregated fund, there can be there are some benefits because it's the choice of the trustees to pick the assets that they want to claim the CGT relief on. And if they don't want to claim it, they don't have to. So there's more flexibility within the segregated method. If it's not the segregated method, and that will often be a case where you have most super funds that would have an accumulation account because there are contributions coming into it, plus a pension account. The time and effort to do a segregation of a fund often outweighs, from a cost point of view, the benefit that people will get. Where there is no segregation in a fund that's made up with an accumulation account and pension accounts, you have to use this proportionate method. And if you're using the proportionate method, at the 30th of June, all assets are revalued to market, and there will be a calculation done on the value of the assets that relate to the accumulation account, and tax will be payable on those with two choices. It either gets paid in the 2017 year when the return's lodged, or you can defer it until the assets are sold. So being able to select an asset and regard it as being segregated and claim the asset, the capital gains concession, is only available to people that have gone for segregation. If you haven't gone for segregation and you've had an actuary do the report every year, you've only got one option, and that is to end up using that method, which could result in some tax payable at some point in time.
Yeah, and actually that's a question I was going to ask next from Julie. She wanted to know about capital gains tax, how that works in terms of the reallocation to accumulation phase.
Effectively, they've been, and Bruce said a good thing before, I thought they were just being generous and not wanting to end up having some retrospectivity part of it. But Bruce was right in saying that by allowing people to protect the capital gains that they've made and not pay capital gains tax on it in the future when they're sold, they've avoided a massive sell-off between now and the 30th of June with people trying to crystallise it. So there's not going to be too many adverse consequences for any unrealised capital gains sitting in self-managed super funds if the trustees choose to use it.
So it's very much an individual decision on whether to segregate.
Case by case, and sometimes it's going to be asset by asset.
Yes, correct.
Yeah. So another reason to see someone who is a professional, qualified, licensed financial advisor.
Yes.
Now, a question from an unnamed reader here, but in terms of the segregation, what's the actual process for that? Is there forms that need to be filled out, or do we know what that is as yet?
Oh, it's been in existence forever.
Yep.
Basically, in segregation, you have to go through every investment within a super fund, allocate it to a particular member, whether they be in pension phase or accumulation phase, and then the interesting thing is you cannot split an asset. This is the tax office interpretation. You can't have a property which is half accumulation and half pension. The whole asset must either be in pension or in accumulation. The only asset that they allow to have two components of accumulation and pension is bank accounts. So it's just a simple matter, and this is why it can be very costly to do. You've got to go through every investment in a super fund, allocate it to the member in pension phase or accumulation phase, but it's more than that, because the income that particular asset has been earned has to be channeled off and put into an area where this is the exempt pension income that's being earned to generate the pension, and then the other from those assets that have been allocated to the accumulation account, which are taxable. So it's quite an involved process.
Okay, thanks, Max. Now, next question, well, it's more of a comment really, but you may have seen that most recently there's been more calls for the family home to be included in the assets test. This one keeps popping up every year, all the time, from different quarters or whatever. So the question is from Sarah, what's the likelihood of that happening? It's, as I said, it's more of a comment, I suppose.
Yeah, look, it is something that comes up every year. I don't necessarily think that it's any more likely or unlikely, as in it's largely been unlikely for a long period of time. The only factor that might change that is the budgetary pressure that the federal government is under at the moment. They need to raise taxes or cut spending, one of the two, and that's the only way I can see that it would get in, is that the pressure from not being able to get their budgets through Parliament, the majority of their budget through Parliament, might make them look at other things. But they could look at a whole number of things, reducing the tax cuts that they were going to be handing to business potentially. We cut back on some other of their spending measures that they'd done. Are they going to put the home in? I can't see that.
I think it's interesting. The people that bring up these hoary chestnuts all the time are the ones that say we should ban superannuation, we should ban people being able to have family trusts, we should ban people being able to do anything within their own grasp, be able to limit their tax. I think we can take a bit of a lesson from these amendments to superannuation, that if it was brought in, and they've effectively brought back something that you and I would have grown up with, is the reasonable benefit limits, which was at one point in time there was an arbitrary decision made that this is what a person can reasonably have in a superannuation account. And to some extent, that's what we've now ended up with by default, by the 1.6.
Yeah.
They may end up looking at it, say, it's reasonable to have a person, and it's highly unlikely that these people are eligible for the age pension anyway, but they may end up saying it's reasonable for someone to have a principal place of residence not calculated in the assets test up to a value of 1.6 million, and then so therefore if someone's put all of their wealth into their house and sitting back eating baked beans out of a can but surviving on the age pension, that may be, that's probably the worst I could see that would be happening.
I think the chatter has got bigger and bigger over the years in regards to it. Technically, you can have a $10 million home and be picking up an age pension. So in the same way that they've moved to restrict, essentially put back in the old RBL, but create this $1.6 million transfer benefit cap for super. It may be coming down. I don't think in the next year or two, but there will be pressure put on for people who have multi-million-dollar homes, who have very little assets outside of that, who are collecting the pension, for them to put a cap on it of whatever they choose, 1 million, 1.6, 2 million, and then potentially say, well, you need to use some of the equity that you've developed in your home before you're eligible for the part pension, which is where something like a reverse mortgage might come into play. But I don't think it's going to be happening in the next few years.
Have you ever? It's often interesting when you look at what we've got and what overseas has got. As far as I know, and it's because I maybe haven't looked at it, and you might be able to answer this, I don't know. The age pension, although it's not really an age pension in the UK. In other words, in what other countries that have this sort of age pension situation, what their rules are. Because it'd be a very brave Australian government that ended up saying, right, from now on we're going to count the value of all of the value of the family home in the assets test, when Australia ends up being the only country that's doing that.
Yeah.
I think,
Yeah.
I don't know.
Look,
enough about
it's a
other
hot
countries.
potato, obviously, and,
Yeah.
and probably too hot to pick up by anyone at the moment, I would say. Yeah.
The other big one that always comes up with this, Tony, is capital gains tax, and or using the age pension, or having a value on the home for things like age pension, but also capital gains tax. You had Labor going to the last election wanting to ban the 50% exemption. The government saying no. There's a story around this morning saying that they may be reconsidering it. And as I was driving in here, hearing the government saying no, it's not on the agenda. But they're two big perennial questions or mud that gets thrown. And
I think the trick is, from the listener's point of view anyway, know what you're dealing with in terms of what's been officially announced, and all the other stuff is really just chatter at this stage.
Yes.
So best to put that to one side until it actually happens. Now, the next question is from June, and June asks an interesting question as well around the $1.6 million cap. June and her husband each have in excess of the $1.6 million cap. So June's asking, in the sense that she and her husband will each have to roll back some of that money into accumulation phase. When her husband passes away, can she roll over his super money into her accounts and basically sort of put the excess into accumulation?
That's a very interesting point, and it's Bruce is, unfortunately, because of his agenda, not being able to get to what is often and the best conference on superannuation every year by the SMS professionals. And this was brought up today, and it's an interesting point, because it almost makes it important to go to the I'm forgetting the term, where reversionary pension. That if a reversionary pension automatically pass to the spouse, they have 12 months to work out what they want to do.
Correct, yeah.
So if the reversionary pension goes to someone, they can end up working out what they're going to do. The interesting thing is, though, a reversionary pension is still a death benefit. Death benefits can either be taken as a pension or must be paid out in cash. So in June's case, if she's got $1 million in her own account now, and her husband has an account-based pension of $1 million, and it's reversionary and it goes to her, she really needs to look at it from a point of view, if she wants to keep the maximum in super, she'd need to keep the death benefit pension going for her husband and roll out the excess of $400,000 from her current account-based pension.
Yep.
Because the only way she could reduce the value of the death benefit pension is to take it out of super. Now, that might not be a bad thing. If June has no other income, it may be better if that $400,000 comes out and she invests it, given that someone, if she's got no other income, she can earn up to about $26,000 or $27,000 and pay no tax. So it doesn't make much sense to keep something in superannuation paying 15% when you can have it in your own hands and pay no tax.
Yeah.
I think with June's particular question there, Max is saying both are in excess of the 1.6 million.
Yep.
So my understanding of that one would be she would probably need to roll her entire pension back to accumulation. So the 1.6, assuming the death occurs after the 1st of July, so she would need, if she wanted to keep it in super, she would need to roll her 1.6 million back to super, where it may join whatever her excess was pre 30 June. Now with the husband's one, let's say there's 2 million, $400,000 would have had to have gone back to super on July 1, and there's the 1.6 million that's still in pension. If there's a reversionary pension in place, then that would come to her, but it'd take up a full 1.6 million cap. I think, and my understanding is, so she would roll everything of hers from pension back to super. She would receive the reversionary pension from her partner, from her husband. The $400,000, whatever the husband's excess had been, prior to July 1, I think that would have to be paid out as a death benefit.
Yeah.
Yeah, so that $400,000 would need to be paid out,
Yep.
but that would allow her to keep the 1.6 million reversionary pension plus the $2 million that she's rolled back from pension to super to stay in super. So 1.6 million pension, 2 million super, $400,000 out.
It's a great example of just how complicated this thing's going to be, and it's very hard to give broad brush advice. That it's going to have to be for each advisor to look at the total situation, not only what's in super, but what's outside of super. The other thing could be, I've often said to clients, look, when one of you, and I'm talking to a couple, goes, we need to start thinking about how much money do you need to have in there, especially if you've got some taxable super. When one of you goes, it's a perfect opportunity to work out on conservative basis, maximising what your life expectancy is, how much you need to generate an income, what sort of money do you need in your super fund. Have you got an excess where it might make sense to have that come out of super, gift it to the kids, or do something like that? It's going to be a case-by-case basis with lots of different scenarios that will come into play.
Yeah, different permutations for everyone, really.
Yeah.
On that, Tony, I've written briefly, and we'll come back to it at some stage, about the 3-pot strategy, which is your first pot is your 1.6 million in super, in pension. Your second pot is somewhere between $500 and $1 million outside of super, where you can earn the $28,000 that takes you up to the tax-free threshold. Your third pot is back inside super in the accumulation phase, where the maximum tax is 15%. And this week, my column has talked about a fourth pot, which is a family investment company. But read that one when the viewers have got the opportunity. But you're talking about needing to understand and get those 3 pots working properly to sort of maximise your tax-free income across 3, essentially three pots.
Would you like a 5th pot? Money going into one of these modern insurance bonds that you can actually have the money go into the insurance bond that you still control, and after 10 years it goes to whoever, someone tax-free. So there's a 5th pot.
Tax paid?
No, if you hold the insurance bond for 10 years or more, no tax payable at all.
Yes. Yeah.
So there's.
The 6th one could be a family trust.
It's a bit like
Well, all I know about pots is if you have too many of them, you get over the limit very quickly. So you got to.
That's right, definitely. Unless you're drinking water from them.
Exactly.
Yes, that's right.
Exactly. Now, a question from Meredith, talking about assets outside of super. Meredith and her husband have got an investment property. It's worth about $900,000, she says, drawing about $25,000 a year in income out of it. She's just wondering what the consequences of that now are in terms of the assets test changes.
Well, from an assets test point of change, if it's worth $900,000, they're blown out of the water, unless there is a loan against it, because it's the net value of the asset. Interesting enough, if they've got a $900,000 investment property,
it's jointly owned though, Max, and half.
But then if it's husband and wife, they can't have more than 816.
Yeah.
But if that investment property had a mortgage of $300,000, but instead of it being secured against the investment property, it was secured against their home, that $300,000 doesn't count, because any loan that is secured against the house, because the value of the house is not counted, you can't decrease your assets for the pension test by that loan. I think this couple really needs to get some advice quickly, because to me they would have some pent-up capital gain in that property. If they can pass the work test or whatever, they've got the ability to be putting in, reducing capital gain by $35,000. I'd be getting the money into, between the two of them, they can get $1,080,000 if they haven't exceeded their non-concessional contribution limits in the past. And this proves my point about property. It is not as good as superannuation. Drawing a $25,000 income from something that's worth almost $1 million is not all that attractive when you've got to try and produce as much income for living purposes. But that would be one that this couple should go and get some very good advice quickly, because they've got an opportunity to do some stuff that will be narrowed and be not as good from 1 July.
Yeah, it's a big problem for a lot of people, I think. They've built up different assets outside of super. and this is now impacting their ability to get pension.
Yeah, one of the hardest things with some clients that I'm advising is Australians are wedded and love property, right? And the hardest clients sometimes to advise is not the ones that don't have much, but those that have got a lot. But a lot of their wealth is tied up in 4 or 5 or 6 rental properties. And some of them may have been an ex-house that their first child was born in, and there's some other sentimental, is to say to them, well, look, you've got a choice. You can keep those properties. Yes, you're going to be probably generating a reasonable amount of income, maybe just to have a reasonable lifestyle. But by you choosing not to sell those now and possibly do some tax planning to reduce the tax impact, what you're effectively doing is passing on that capital gains tax problem to the people, which are your children. And whether that's smart or not, I don't know. I think there are better ways to deal with it than just letting it keep going as it is.
Mm-hmm. And the other problem, obviously, with holding sort of hard assets like property is, any assets that are large, getting them into super's going to be hard if you're in accumulation phase anyway, at the current rollover caps, but then that's going to be cut down from July 1.
If it's residential property, you can't even do that.
Blanket ban.
Blanket ban.
Commercial property is still a possibility, but
what I'm saying is, if you sell the asset,
you can sell the asset and then you can get it in. I mean, this is the thing. This is why this couple have the ability to get up to $1,080,000 in before if they're under 65, they can get 360 between the two of them if they're over. Whereas if they wait till after July, it's only going to be $200,000. And if they had the ability to pass the work test and get the deductible super contribution, they're going to be able to only put in $50,000 between the two of them to reduce their tax from 1 July, whereas they'll get 70 now.
Mm-hmm. Question from Kathy. Kathy can't tune in today, she told me, but she's got a question. She's going to have a listen back to the Q&A after. It's around Kathy's over the 1.6 million cap. She's saying, does the accumulation account need to be a separate bank account totally? No?
No.
Can be all in one?
Yeah, that's fine. You've got potentially multiple members, multiple super pension accounts. They can all run through the same bank account as a general rule. So it doesn't need to have separate accounts and separate ComSec or E-Trade accounts to hold the various assets. No.
And part two is, Kathy says that if you're getting an actuary to look after all of this, does she actually need to do anything, or is that just looked after? She's just saying, I probably don't need to do anything.
No, it's normally looked at the accountant's level or the super administration. If she's using a super administrator to look after it, it just becomes a natural part of it. And, the SMSF trustees out there need to be aware. One of the biggest problems I've seen with the SMSF industry is, in some cases, certain sectors of the financial services industry, which recently have been in the news a lot by putting their profits ahead of their customers, and that would be the 4 big banks, is that often what is charged for something ends up being a lot more than the true cost. So if you are, like I think I can get an actuarial report for about $110. Be very careful of what you are being told the cost is. In these days, in fact, I saw an actuary give a presentation yesterday. And he said they've got it to the point where they have their big computer models, they plug it in, and that's what all of them would be doing, and it takes them a few seconds, spits out the information, so it's something she doesn't have to worry about. That'll be done more at the administrator or the accountant level.
Right. Another question from James. It's around the $1.6 million cap again, and we've probably covered this off, but in his particular situation, he's got $1.8 million of assets, an investment property worth 1.2, 600,000 in shares and cash. He wants to know if he needs to divest $200,000 basically to conform with the 1.6 mil cap from July 1.
$200,000 of it will have to go back to accumulation.
That's right, yeah.
Essentially, that's it. That's 1/9 of his fund. So essentially, 1/9 of the fund will pay income tax on the income and capital gains on the capital gains, taking in mind what we were saying before about cost-based resetting, etc., which will occur on around the 30th of June.
Yeah. Now, this one I'm going to read out just because it's a bit of a long-winded one from Alan. Alan's 68, have about 2 million in my SMSF. Under the current rules, I must withdraw at least 5% as a pension, say 100,000. Under the rules from July 1, I'll have 1.6 and 400 in accumulation. Do the minimum drawdown rules apply to both accounts or only the pension account?
Yeah, only the pension account. So the pension account pays the pension. The accumulation account can sit there. And the government's happy for it to sit there, sort of, forever because it's paying tax. Only at maximum 15%, but it's paying tax. The reason you have to draw a pension from a pension account and can't just let it grow and grow and grow is because it's not paying any tax. So you have to draw, depending on your age, 4, 5, 6%, and that needs to be drawn, from the pension fund. If you're over 60, the income's coming out to you tax-free, but whatever the pension fund earns, it gets to stay in there tax-free. Whether it's income or capital gains, gets to stay in there. Now, I'm not sure if we got a specific question on this, Tony, but I certainly had a lot of questions about it, seen a lot of questions come through, is, well, if I have 1.6 million, I have to draw 5% of it, or I have to draw $100,000, and I'm at 1.5 million, can I top back up again to 1.6? The answer is no. Your transfer balance cap of 1.6 million on that date is that. You can take the minimum pension you want, and if you're getting growth on top of that minimum pension, then fantastic. So minimum pension on 1.6 million would be 64,000 for somebody taking a 4% pension. If your super fund earns $200,000 that year, then you've got the rest of that. It's grown to above 1.7 million. If you take a 4% pension, $64,000, and markets and whatever fall 10%, your pension has fallen to around the 1.4 mark, a little bit below 1.4. Unfortunately, that's tough luck. That's the way that it's going to work. What you transfer into pension on the 1.6 million transfer benefit cap, if you put in 1.6 million, that's it. You'll never get another cent into a pension fund again. Even when CPI eventually takes the $1.6 million current limit to 1.7 and to 1.8, it'll increase in $100,000 lots according to CPI, so maybe every 3, 4, 5, 6, 7 years. If you've used the 1.6 and it goes to 1.7, you can't add another $100,000. If you put in 800,000 of the 1.6 million and then it goes to 1.7, some years down the track, you'll still be able to use your 800 if you have extra money to put in. Because you'd only used 50% of your 1.6 million initially, you would then be able to use 50% of the extra 100,000 that's been put in. So if you were doing it down the track a bit, you could potentially put in 800 plus the $850,000 in a pension. But no, you can't top up your pension account. 1.6 million is it.
The only thing, and it's interesting, some of the strategies that are out there, like it would make sense, given that the only things that will increase the pension accounts will be accumulated income after all of the pension payments. So therefore there is one line of thinking that would be making it saying that you would take your minimum pension payments from your pension account, and if you've got excess money in an accumulation account and you're 60 or over, you'd take them as partial commutations to make up any, if you needed more money for your lifestyle. There was another concept that came up at the conference where if you want to, you can actually take partial commutations from the pension account, and because partial commutations will decrease the value of your pension transfer balance account. And so therefore, if you're doing that and you get down to a point where your balance has gone below the 1.6, my understanding is you can then put back up. As long as, if the pension account comes down to 1.5 and your limit is 1.6 and the thing that decreases your transfer balance account are commutations, you could put another 100,000 in then. But then I don't know which is going to be the better option. Taking it as commutations from your account, from your accumulation account, or doing the other.
Looks like I've got some reading to do there, Tony.
It's amazingly. The other interesting things, recontribution strategies. They are still going to be possible even with this pension cap. If someone has a major component of their pension account being taxable, taxable. Because of the pension cap, if you've contributed or if you've got the 1.6 million used up, you can't make another non-concessional contribution. If you pass the work test or whatever it is, you're able to actually rechristen taxable to tax-free by doing, in June of 1 year, a partial commutation of 300,000 out, which therefore means your transfer account balance has gone down to 1.3. Then you can put the 300,000 in as a non-concessional, and that will increase your tax-free component. So the changes are complicated, and the various planning opportunities around that they're only going to increase, because as we know, once the legislation's out, all of the clever people will be ending up looking at which ways can we twist and turn this to give the clients the benefit.
Absolutely, and that's what it's all about, really, just getting proper advice, because it's so dynamic. There's a lot of confusion out there still in terms of what different things mean. A question from Vivian. She wants to know about transition to retirement pensions. Will the 15%, has the ATO clarified whether the 15% tax on those will apply to someone aged over 65?
Well, at age 65, it automatically becomes an account-based pension. So
it doesn't.
So it's irrelevant.
Yeah.
Yep.
It's only if you're 64 and under that you have a TTR based on your preservation age when you're turning it on. But at age 65, that's the ultimate condition of release. And at age 65, all benefits, all super benefits become tax-free. Certainly, a TTR becomes tax-free, and no tax to pay in the fund beyond that point.
Were you surprised they left it? I mean, when they brought out this concept of TTR, I thought, gee, Peter, Mr. Costello, sir, that is being incredibly generous, allowing people, because their big problem was they ended up saying that you're able to end up going to a TTR if you went part-time, or I forget what the term is, but they didn't define that what that was. So anyone could just say, I want to start a TTR pension, and in the end, I don't know how much of a benefit they're going to be. I think their benefit to people under 60 is going to be very questionable.
Yep.
For people 60 to 65, you've really got to do your sums to work out whether a TTR pension gives you what you want after the fact that the income's going to be taxed at 15%. So yeah, I don't know whether down the track we might not see that they will sink into the U's and they may no longer exist. Because
well, I mean, they've been cutting back the effectiveness of them for years anyway, particularly with the reduction in the concessional contributions cap from 150 to 25, back up to 30, 35, then back down to 20. But certainly, what happened? The reason for setting up TTR was to allow people to shift back from 5 to 4 to 3 days a week and top it up with. But that's not how anybody used it.
No.
Very few people used it that way, and most of it were using to reduce their tax over time, to reduce the tax payable on contributions and receive a tax-free income. So it got abused. So, and that's essentially why they were doing it.
Great, thanks very much, Bruce. And thanks, gentlemen, for joining me again today. Now, before we wrap up, I just wanted to quickly talk about another webcast that we've got coming up next week on Tuesday at 11 a.m. Mitchell Snedden will be talking about holding the right types of passive investments in your fund. Now, to register for that webcast, just go to the InvestSMART.com.au website, and he'll walk through what sort of strategies you can employ in your investment portfolio to provide a passive approach to your investments. So thanks again for joining us today. I'm Tony Kay, I'm the editor of Eureka Report, and we look forward to you joining us again next time. Thanks again to Bruce and Max for coming in.
Pleasure, thanks, Tony.
Thank you.